What's up, guys? I hope you're doing well. I just want to go over my recent post over something that I think at least is really interesting. I mean, it's the kind of the origin story of the Federal Reserve itself, which is surprisingly interesting. Considering the fact is like a lot of people think it's like, oh, the creation of banks and stuff. It could be kind of boring. Um, Not so much with the Federal Reserve. Actually, a lot of it kind of it sounds like a conspiracy theory, to be honest. Um, but anyways, we'll get right into the screen share, and this is one of the things that I'm kind of just using the post as a kind of as an outline, so I don't go down too many rabbit holes, because this is something that I think is very interesting, and I'll easily just rant about it. I need to remember to start making it bigger, change the screen for you guys so you can see it better. Anyways, so one of the things, and me bringing up the fact is like, it kind of sounds like a conspiracy theory at first. You'll definitely understand why when we get more into the story. But one thing I kind of want to note is, I mean, this is all stuff that's like even on the Fed's website, like, and the people who originally, like, I guess you could say, founded the actual Federal Reserve itself, even came out and talked about it. Right? This is not like a kind of a puzzle piece together story. This is like a here it is by multiple different entities who, I guess you could arguably say, had every kind of, or would be incentivized to not bring it out, for obvious reasons. But anyways, so essentially this whole thing started on November 20th to 30th of 1910, and it actually was an estimated like quarter of the world's net wealth, right? I know there's some argument depending on like the on there's some argument with respect to how much of the world's net wealth was there. It was, but still, it was like between like 20 and 30%, and that's a lot considering there's only like six or seven people with the names such as like senators like Nelson Aldrich, Frank Vonderlip, Abraham Andrew, Henry Davison, Benjamin Strong, Paul Warburg, stuff like that. They're all have interesting backstories too, which wasn't the purpose of this one. This post, at least. It was more on specifically the Federal Reserve itself, and so I didn't go too far in depth with the actual individuals, which will most likely be subject to future things because they are, especially Paul Warburg, because he was kind of the whole. I don't know if mastermind is the right way to say it, but either way. Um, But yeah, and one thing I kind of want to note beforehand, and this is more of a general topic or a general kind of question, right? Is one thing you have to keep in mind with these things is like, is it the intentions of those individuals or the consequences of what they did, what really matters? Um, and like I said, that's more of a generalized thing and kind of something to keep in mind when you're doing it, or like whenever you're thinking through something like this, not just like with, say, the founding of the Federal Reserve, but even like, regular um, policy decisions or politics or whatever. I mean, just it kind of applies to a little bit of everything, something to question. Um, Speaking of which, here's the actual clubhouse. And so Jekyll Island is a island off the coast of Georgia, which is basically a kind of like, I guess, a rich person's like playground, so to speak, as you could think. Like they had like horseback riding, the typical what you see in the movies of like the old, like really rich guys, the old bankers and everything else, what they do on like a weekend or whatever on vacation. That's what they had there. So pretty much the primary reason this meeting happened to begin with was they deemed it that there was major problems to begin with the kind of the American financial system. And so during this time between, say, the Civil War and up to the passage of the Federal Reserve Act in 1913, America was more in a period of something called wildcat banking, to where it was much more of a banking itself was much more of like a free market enterprise, right? To where you had sometimes state banks, sometimes private banks, but there was no like kind of how to describe it. It's very much like a like businesses are today, so to speak. Like banks could have their own currencies, and then They could have different lending policies at different banks, and so it was called wildcat banking for a reason, because all of them could be somewhat different. Um, and there was even times to where like you'd have obviously with stuff like that, you'd have banks that were like would show up for like a month or two, get all the deposits, and then pick up and leave overnight. Um, but regardless, so one of the arguments against the system to begin with, and one that was rather consistent with all of the different, guess you could say, arguments of the participants of the Jekyll Island meeting, was the fact that this system was prone to liquidity freezes, right? And so basically, if something bad was happening, reserves would have and money would just stop flowing, which I guess you could argue doesn't really change much from today, but the system's a bit different, I guess. Um, but anyways, bank runs and currency drains were a major problem back then. And that was kind of the whole like I forget there's a movie out there specifically on like a of the like Great Depression, and it was like a private banker who like they had just like he just got married or something, and they had to there was a his bank he was a banker, and they like had a run on his bank right when he was about to go to his honeymoon, and they had to use the savings for their honeymoon to bail out their own bank, right? From my understanding, it's kind of a well-known movie. I'm just terrible with titles, and so I think it's in black and white, but I don't remember. It's been so long since I watched it, but that just popped in my head. So that's kind of what a bank run is, right? Where you have all the depositors, sometimes literally back then, running to the bank to pull their deposits because they were afraid that the bank wouldn't have it anymore. Currency drains, on the other hand, are somewhat similar, but it's more of from the settlements between the banks. And so, like if you make transactions, say, like if you buy something from a business and that business has a bank account on a different bank, then your bank and their bank have to settle, right? So that, that neither bank gets screwed with their balance sheets. And so essentially, if the lending requirements, or I guess the lending policies of different banks, since they were different, or could be different, ones that tended to lend more um, would end up having their reserves to a higher degree flow out. And so eventually they'd run out of reserves, and kind of they'd fail for the same reason as like a bank run would, just through a different method, I guess. And so one of the things that kind of started this, or kind of the main model for the Federal Reserve in this time, was they actually looked over into Europe, and this is where kind of Paul Warburg comes into play with his because he was a German-born investment banker, and so he would advise a lot of people. In this case, like Nelson Aldrich, who was a forget which state he was a senator for, but he was a Republican senator at the time. But anyways, not to get ahead of myself, basically the difference between these European banks and the American banks was, at least their argument was, that the European banks comprised of a lot more short-term commercial paper, and so basically they were less prone to liquidity freezes. And that basically allowed them to not, in the events of bank runs, they were much more well equipped to take care of it and not become insolvent. Um, Another thing to note, this was in the 1910s, or like the first decade or two of the 1900s. And so we were on a gold standard in the United States. And then they also say that so that being said, the, the currency was pegged to gold, right? So the value was pegged to gold. And then the supply of the actual money was supplied by the government bonds. And it was like some special type of government bond, to where it wasn't very, they didn't make a lot of them for some reason. So yeah, basically they just specifically Paul Warburg used the word archaic with the Federal Reserve System, or not, excuse me, with the American banking system prior to the meeting. And another thing that the banks had was they had trouble clearing checks outside of city boundaries, and so, like, again, the settlement process was a pain, and so they actually like they'd have to sometimes physically move cash between cities. And as you can imagine, this is when you're moving over especially when you're moving a lot of money across long distances, especially back then, there's a lot of risk to that. um, and that's surprisingly still somewhat of a problem today, not to the same extent, but the Federal Reserve today, or not today specifically, but like in the past month or so, came out with kind of a program, or announced a program or something called cash visibility. Basically making cash more visible and kind of modernizing the process of the actual physical cash being transferred between banks and such. Because sometimes it was, I mean, it's still like people driving the Brinks truck and they're using clipboards and paper and pen to transfer all this stuff. Whereas, other stuff. And I linked to a YouTube video that I did over the entire thing. And so I went over the article itself and talked a little bit about it. So essentially, kind of the catalyst to this whole meeting at Jekyll Island was the panic in 1907, or at least it seems. Um, at least that's how the Federal Reserve states it, which is kind of what I'll be going with to start with, just because, I mean, you got to look at all points of view, I think. And so essentially, this panic, they were becoming rather frequent. And so basically, they said there were two other major banking panics and then eight more localized throughout the United States between the Civil Wars, 1860s, up until passage of the Federal Reserve Act. Part of that was due to the fact that the all those banks in the United States, and they approximated about 27,000 different banks throughout the United States, were all connected in kind of a system of like interbank deposits and clearinghouses. And so whenever something happened way down the line, as say some small local bank, well, there'd just kind of be a chain reaction, and that would spread rather quickly throughout the system. Um, so yeah, and so in response to this, there was a bill in which our kind of, I guess you could say, main character or whatever, Nelson Aldrich, um, sponsored in 1908, which created the National Monetary Commission. And basically, the whole point of that commission was to study and see if they could reform the financial system, right? And so essentially, he ended up hiring Henry Davidson, who was a partner at J.P. Morgan, and then I think it's Abraham Piet Andrew, who was at the time was an economics professor at Harvard. And they were his advisors, and they traveled to Europe a few times to study the banking system and come up with a model for what would eventually become the Federal Reserve. Slightly different. Um, so yeah, and the reason this panic in 1907, I guess was, I don't know if it would be so much of a catalyst for kind of a government. I don't know if it would be more of an incentive for the government to do it at the time, but essentially, J.P. Morgan and John D. Rockefeller had to bail out the institutions, right? And so that basically those New York bankers, because you'll notice when you go through all the participants, I believe they were all from New York, or at least worked for the New York, like worked for banks or financial institutions in New York. So it was very kind of a Wall Street feel to it. Um, they said that like if their assets, like even with their amount of cumulative assets, they wouldn't be able to stop much of a bigger panic. And so their whole idea was to start a central bank. And that was kind of the fix, so to speak. And that's where you kind of get into the more conspiratorial, or what's deemed to be conspiratorial. Don't have much of an opinion on whether the theory is correct or not, at least not yet. That's what the blog's for. But yeah, that's where you get kind of the differences in intentions and the reasons behind the whole starting of the system, right? Was it really some malicious intent to kind of push off the essentially get bailed out all the time. Um, so, anyways, I'm gonna save that for later because this shouldn't be a 48-hour long video, but we're gonna keep it to that from now on. And essentially, this whole panic of 1907, the reason why it worried the New York bankers so much was that it it started with trust funds and other financial entities that were outside of kind of the view of the national banks, and so they didn't have much of a they didn't see it happening before it was kind of already going, so to speak. Um, Kind of more on the actual story itself of the meeting. And so this started with the group's participants in general. Some of them I've already stated. So there's Aldrich, who and his private secretary, Arthur Shelton, Henry P. Davidson, who is the partner at J.P. Morgan, uh, Abraham Piat Andrew, the assistant secretary of the U.S. Treasury at the time. Then you have Frank Vonderlip, who was the president of the National City Bank, and then Paul M. Warburg, who was partner at Kuhn, Loeb and Co. And essentially, this whole thing, the whole kind of, I guess, the story itself and why it's kind of deemed a conspiracy theory sometimes, or at least by some people, I guess, is the fact that it's like all of these people met at a New Jersey train station, and they got there one at a time, some in disguises to like conceal their identities. They only used first names. Um, it was kind of the ruse was set as it was a duck hunt. They were all going to go duck hunting, right, and not actually, you know, plan the monetary system, so to speak. Um, and there was one, I forget which one of them, but I read somewhere this kind of a story or whatever that he like actually came in, like he showed up in all duck hunting gear, and like he borrowed a shotgun from his like one of his relatives, even though he's never shot a gun before or something. Didn't cross wow didn't cross reference that one, but just thought it was an interesting put in there. And so essentially what they did, or what they came up with at least, is they had to fix these problems. Like, so they had to fix the fact that, you know, in kind of panics, um, the bank reserves would become immobile, right? They wouldn't move, and you'd have basically freezes, and the whole system would seize, and banks would fail, and everything. Standard bank run story. Um, the plan they came up with is going to sound rather familiar. And so initially it was called, in their proposal, was the Reserve Association of America, because you can't call it a central bank, for reasons that will become more of an applicable topic in a minute. But anyways, it was a single central bank. It had 15 regional branches where each branch was governed by a board of directors. Um, and who all of these and these directors were elected by the member banks within their region. Um, and then those branches were responsible for holding the reserves for their member banks, issue them currency, and then discount commercial paper, um, basically the loans and such, and then settle accounts between the banks as well. So you no longer had to transfer the money between towns or sometimes even states, depending on the region, to settle transactions. They could just literally, um, you know, notify their regional branch, and then they would just settle the accounts on their own books. Um, Much like if you transacted with someone where you both have accounts at the same bank. Um, so yeah, and then there was a national bank and then the national bank oversaw the 15 branches and was basically responsible for open market operations and then setting discount rates for the entire system. And so it was that national bank that was responsible for the buying and selling of, say, treasuries or some other form of some form of commercial paper or other assets that we now kind of know about. But what happened was, this all happened in 1910, 1911, right? So the actual meeting was late 1910. And then in 1911, specifically in January, when the National Monetary Commission met again, Aldrich proposed his plan. And if those dates sound familiar, who got elected in 1912, right? And so there was a presidential election coming up in 1912, and since Aldrich was a Republican, or just for the fact of people don't like, especially back then, it's arguable now. The mass of the population didn't like central entities all too much, at least to some degree. And so the Democrats took advantage of this, and kind of the general uneasiness of a centralized monetary authority, and they killed the bill, specifically with the president, or with Woodrow Wilson becoming the president, right? And then they also had control of both houses, and so they were able to kill the bill rather easily, at least respectively. Or I guess relatively, my bad. But you still had to keep in mind they couldn't allow these banking panics to continue on like this. And so they created their own banking plan, which sounds very familiar to Aldrich's plan. Actually, some of the sections were literally verbatim the words from his plan. And this was written by Carter Glass and Robert Owen. And this is the version that became the Federal Reserve Act in 1913. And so basically, I think the reason behind the application of a new plan was the Democrats specifically had problems with, say, like the political structure and the decision making kind of structure of the whole thing. They didn't like kind of it's one entity with different branches. So instead, it was multiple different banks, the reserve banks, and kind of had like government or kind of central like entities that kind of connect them all together, like the FOMC does now. So yeah, and kind of a little bit more on the background, which will make you kind of understand to a greater extent why it was the original meeting was done in such secret, was because of the backgrounds of all of the participants, right? So Aldrich was a prominent Republican. He was also allegedly a business associate with J.P. Morgan, and was also well known as the father-in-law to John D. Rockefeller Jr. His daughter married him. And then Frank A. Vanderlip was the president of National City Bank of New York at the time, and beforehand, or he was the president of that bank at the time of the passage of the Federal Reserve Act, and then beforehand, he was the assistant secretary of the Treasury. It was like a decade before. So that would be in like the early 1900s, I think. So like 1903, 1902, sometime in there. And then Abraham Piet Andrew was the economist at Harvard that we talked about in the very beginning of the video, who advised Aldrich in the original kind of study of of possible reforms. And then you had the assistant, and then he became the assistant secretary of the Treasury during the time of this whole thing. And then Henry P. Davidson was the vice president of the First National Bank of New York, and he founded the Bankers Trust Company, which he grew into the second largest trust company in the country. There we go. Words. And then you had an interesting one was Benjamin Strong, who was the president of the Bankers Trust Company of New York, and he actually became the first governor of the Federal Reserve Bank of New York. And so back then, what we call the presidents now, they called governors. So there's obviously been a few revisions to the Federal Reserve Act since then, but one of those was back then they called them governors, but now they're the actual presidents of the reserve banks themselves. And it's actually there's been some debate I've noticed over whether or not he was actually present. For example, he had family members state that he was not there, but in one of the memoirs of, I believe it was Vanderlip, his memoir that he wrote about the meeting, he explicitly stated he was there. He was present. And so it's kind of like, do you believe his family or do you believe one of the people that was there? And it's like, well, I'm just here to state that there's debate over that. And then there's finally there's Paul M. Warburg, who was that German investment banker we talked about, and who he actually advised both Aldrich and Glass when they developed their plans. So he was kind of the whole the glue that held it all together, right? Kind of the whole reason to wrap up, so to speak, that I did this, I made this post was and kind of a, I guess, a personal belief of mine is that sunshine is kind of the best critic, so to speak. So like whenever you have various like arguments and stuff, the best way to really, get to the bottom of it is to get it in front of the public. Really get as many different points of view and actually have, an intelligent discussion about it um with say sources, with just have an actual like intellectual discussion about it and actually like try to understand it. It's in that understanding, right? um yeah, but that's pretty much it for the actual founding of the Federal Reserve, at least so far, at least from the meeting itself. One of the things that I think is really interesting, and kind of the book that made me kind of start looking into this specifically to begin with, was the Creature from Jekyll Island, which I've seen even just doing like standard like keyword research on the front page of Google. There's two, I believe it was two articles that were written about his book specifically, G. Edward Griffin, and he where they explicitly state that he's just a conspiracy theorist, right? However, it's been rather interesting because he has a lot of citations in that book. Um, and that's one of the things I just get giddy over. I like actually going back and looking at the citations after I read something like that. There's some of it to where I read the book, or like I've read a few sections and I'm like, I don't know about that, chief. Or there's some of them it's more over stuff that I am more familiar with, specifically like in kind of the idea of like what is money itself. Um, to where I'd read it and be like, that's not really how it. Yes, but not really. But in terms of the actual like the Federal Reserve and all of the stuff that like the stuff that really matters, and it's not literally nitpicking little things, because I mean it's a 600-page book. You can nitpick stuff all day. Um, and again, it's a matter of opinion, I guess. But I highly recommend reading it. I mean, I'm reading it right now, actually. Um, it's on my floor, and so it's literally like have it upside down, just highlights galore all over the place. And he actually has like a lot of like little citations, and I've actually been going through, especially like the other stuff, to where you'd read it and be like, I don't know if I quite believe that. And then I'll like actually go and look up the citation, and he'll give like like a professional citation, like with what I would do for the publications and stuff that I'd work with in college. It's cited in very much the same way. Obviously, it's different because it's not physics. But say like when you're dealing with what I've noticed from citations of reading like history and stuff, it's the same format, it's the same stuff like that. But yeah, that's all I got for this one. So it's definitely an interesting topic. It's something that's requires a lot more, like I feel like this is a topic that I'm sorry, I screwed up. I think, because that's one of my pet peeves, and I'm really trying to get out of that habit, the whole I think versus I feel stuff. But I think that this is definitely a topic that you could like devote a life's work to this, with like 600 pages for a book with a lot of citations. I That takes a long time. So anyways, that's all I got for this one. So I hope you guys found it interesting, at least. And I'd love if you guys come up with other sources or whatever, um, like different sources, different books to read. I mean, I literally like I read this one, and then went on Amazon, typed in for similar books on the Federal Reserve, and then just went through the whole front page, or I guess first page, and then just add to cart, add to cart, add to cart, and then bought them all. Um, so there was like, I think 6 other books, because some of them, it's Amazon, it's a search engine, so it wasn't 100%. Not all of the books were completely applicable, But most of them were, and like the one specifically for like central banking and stuff, it was just like getting those, and those are getting shipped. Like one of them was specifically Paul Warburg's. Forget the name of it. The one he's really known for. It's a beast of a 900-page. It's a boat anchor. Um, has multiple volumes. It's the one where he actually came out when he published it, stating about his involvement in the Jekyll Island meeting and everything else, where he talks about that. And so and he goes into a lot of like, I think there's one section in there where he literally compares Aldrich's plan to Glass's plan side by side, and literally just starts showing the similarities, showing where it's verbatim, where the differences were, and so on. But yeah, I'm excited to read it. I'm sorry, or I'm not sorry at all, actually. But yeah, you guys will definitely hear about it if you continue watching and stuff, because there'll definitely be posts about that. But anyways, I hope you guys have a good night, and I will see you on the next one.